Superstars. Welcome to the Accounting Superstar channel. Glad you're here. I'm Professor Don Bush. Been teaching accounting for about 30 years, been a CPA for about that long. And I've got great ways to explain accounting to where I can make it easy for you, easy to understand. People tell me I'm really good at making things easy to understand, so I'll do a good job here for you. So today's lesson is about depreciation again. I just did a video on depreciation. And here's the second one. What we're doing is we're adding just a little bit more to the story. Not much, just a little bit. So here we go. You can do it. Now this is probably about your third week in accounting class. And in about your fourth week of accounting class, you start studying adjusting entries. And adjusting entries happen at the end of the accounting period. So they only happen at the end of the month or the end of the year. And what the purpose of adjusting entries is to make the financial statements a little bit more accurate. No mistakes have been made here, but we're just trying to tidy things up to make things a little bit more accurate. So here's what's happening with Social Media Partners. It's a company. They bought another vehicle here. In the last lesson, they bought a Mercedes, which was a big mistake. And so this time they are buying a Subaru. So this Subaru cost $35,000 brand new, and Subarus are great, very reliable cars. And I think they're still the most popular car in Colorado, where it snows a lot. So, and Subarus hold their value. They're pretty amazing. They don't lose that much value. So if you buy a brand new car, if you buy a Subaru, you won't be getting poor that fast as you would buying a Mercedes. So anyways, here's what's happening, folks. The original cost is $35,000. And the market value is just decreasing year after year after year. And at the end of the fifth year, it's still worth $15,000, which is still pretty darn good for a new car, for a car that's 5 years old. And so now, that's not quite what we mean by depreciation. Yes, the value of the car is depreciating, but that's not how accountants think of depreciation. They think of depreciation as using up the asset, as consuming the asset, or allocating the cost of the asset over the number of years that the asset's going to be used. Now, this car is going to be used for 5 years. So if we follow the same lesson from last time, what we would do is we'd say, okay, the original cost is $35,000. It doesn't matter how you pay for it. You can pay cash, payments, that doesn't matter. But it costs $35,000. And over 5 years, that would be $7,000 per year. So what we would do is we would have here $7,000. And let me get that there we go, in a color that you can see. And I'm just going to copy this across here. So there we go. So the accountant would simply take depreciation of $7,000 each and every year. And so this is to represent using up the asset. It doesn't have anything to do with the asset's value. So let's go down and let's just review here. Let's just review what we did. Here would be the journal entry that the accountant would do, and this is exactly like last time. We would have depreciation expense and accumulated depreciation, and this is something that you probably should just memorize. Just memorize. It's not that hard. Expenses are always listed first here, so that's easy to remember. Depreciation expense, and this funny sounding account here, accumulated depreciation, it's listed second. It's a credit. So here's how it all works. The depreciation expense goes on the income statement, and I hope by now that you know at this point in your accounting education, only two things go on the income statement: revenues and expenses. That's it. Nothing else. No cash, no whatever else. It's just revenues and expenses. That's it, period. If you add anything more to your income statement at this point, you're wrong, okay? So don't do it. Revenues, expenses. All right, so there's our depreciation expense. Now, the accumulated depreciation comes over here to the balance sheet. So on the balance sheet, what we have under the assets is we have a vehicle that originally cost $35,000. And if you're wondering where that number come from, well, it's what we originally paid for the car. And the accumulated depreciation is $7,000. It comes from this journal entry right here. And we only have 1 year of depreciation, so we'll just have 7,000. And so the book value, or the well, the book value here is $28,000 here, folks. So according to the books, this vehicle is worth $28,000. Now, in reality, this vehicle, according to our market value chart here, which is pretty reasonable for a Subaru, the market value after 1 year is $30,000. That is, if we put an ad on Craigslist, we could probably sell this car for $30,000. But according to our books, it's only worth $28,000. So the point here is that the book value and the market value have nothing in common. They don't mean the same thing. They are not meant to mean the same thing. So just totally get that out of your mind. It's nothing to do with value at all. It's just the way that the accountants are accounting for using this vehicle. All right, so just to review again, we'll only do one more year here because the other video covered this quite well. So in 2002, the market value of the cars dropped down to $24,000, and which is still not bad here for a Subaru. And the accounting depreciation here is $7,000 because what we did is we said that original cost of $35,000, we're going to use this car for 5 years. So what we'll do is we'll take that $35,000, divide it by 5, which equals $7,000. And what we'll do is we'll expense this car at a rate of $7,000 per year. And by the way, this is called straight line depreciation because they say it's like a straight line. It's the same amount all the way across. So in the second year, we would make the exact same entry. This entry will never change during the life of this car here. It's just, same thing over and over again. That's why I say just memorize it, and that way you'll know it and you'll have it. And the expense comes down here to the income statement, and the accumulated depreciation flows here to the balance sheet. Now, since this is the second year, instead of having just 7,000, we'll have 2 times that because it's the second year. So this is going to be 14,000, a negative 14,000. So the book value is 21,000. Now, just one more time here, the market value is 24,000 at the end of year 2. And according to the books, it's worth 21,000. And you might ask, well, why are they different? Why shouldn't they be the same? And no, they shouldn't be the same. And they usually are not the same. And they're not meant to be the same. That book value and market value have nothing in common here. All right. So that's all there is to it. So let's add one little thing into our story here. Let's say that we say, okay, this car, it's going to have a value at the end here of $15,000. There we go. I put it in a nice yellow gold color here so it stands out. So at the end of 5 years, what the company plans on doing is getting rid of this car. And they feel that at the end of 5 years, it'll probably be worth $15,000. And that's probably pretty accurate for a Subaru. So, so what we're going to do is we're going to call that the salvage value. Okay, the salvage value. So our way of figuring out depreciation is going to change just a little bit. What we're going to do is take that original cost of $35,000 minus away that salvage value of $15,000. Now 35 minus 15 is 20. And we're still going to use that car for 5 years, so we're going to divide it by 5. So let's see here, 35 minus 15 is 20, and divide that by 5, you get 4,000 a year, right? 4,000. Not 47, but 4. There we go, 4,000. And I'll just copy this across. So there we go. So so what's going on here is we're subtracting out the salvage value because it'll provide a better matching of how much of this asset we're using up each year. All right, and so and at the end, when we sell for $15,000, we won't have to do any fancy accounting with gains and losses and that kind of thing. So it'll work out a lot nicer. So here we go. So it's, other than that, it's the same old thing, guys. Same old thing here. So the journal entry is going to be the same, but instead of 7,000 like it was in the other example, we'll have 4,000. So, and this entry is going to stay the same each and every year. Now the expense drops down to the income statement. And over here, the accumulated depreciation is going to come over here to the balance sheet. So here's what's going on. The vehicle cost originally $35,000, and we have accumulated depreciation for the first year of $4,000, and that gives us a book value of $31,000. Now you might say, hey, it still doesn't match. The market value up here is supposed to be 30, and the book value is 31. Why is there a difference? Well, there's always going to be a difference. They're not meant to be the same. Market value is totally different than book value. So don't confuse the two. Don't equate the two. They're not related. All right. At the end of the second year, we're going to have a depreciation again of 4,000. And to find that 4,000, we used our little formula here: original cost minus that salvage value, divided by the 5 years. So we get the same entry as before. These entries stay the same. And that expense comes down to the income statement. There it is. Now the accumulated depreciation, the way it gets its word accumulated, is that it grows and grows and grows, right? It accumulates. So at the end of the second year, we'll have accumulated depreciation of minus 8,000. There you go. So according to the books, this car's worth $27,000 at the end of the second year. And again, you might say market value is 24. Why are they different? Well, they're going to be different, and it doesn't matter that they're different. They're not. It's not the same thing. Book value and market value are not the same. Alrighty. So if we continue this and we depreciate it every single year, in the 5th year, in the last year here, we would again do this journal entry exactly the same way. Depreciation expense would show up on the income statement. You guys know only 2 things on the income statement: revenues and expenses. That's it, nothing more or nothing less either. And over here on the balance sheet, we would have the vehicle for 35, and the accumulated depreciation, well, since this is the last year, we'd have 4,000 times 1, 2, 3, 4, 5. So that's $20,000. So let's put 20,000 there, and the book value at the end is 15,000. Now in this case, the market value and the book value do match. That's just a coincidence. And you know, when we go to put this car on Craigslist, we might find out that it doesn't sell for what we thought it would. Maybe the market value is more or less than we thought. But for now, that they do match, and that's just happenstance. That's not on purpose or anything. It usually doesn't work out this nice. But anyways, that's all there is to it. So here, the new thing about depreciation today is that the way we calculate depreciation, we take the original cost, 35,000, minus away the salvage value, which is what we think it'll be worth at the end of the 5 years, and then divide it by the number of useful years, and there are 5, so we get 4,000 per year. So there we go. And at the end, when everything's all depreciated, the book value should equal the market value, or close. They're not going to be the same, but hopefully they're close. All right, and the reason why we do this is we have a better matching of expenses with revenues. All right, so if this lesson helped you out, hit that like button, hit the subscribe button, folks. I'm going to be making a lot more of these videos, so don't want to miss out. And let me know what topics you want that give you trouble. Let me know what topics you want to learn about, and I'll make a video for you. So until next time, over and out.